Hey guys, welcome back to the Capital Mindset Show. Today's going to be an interesting, well, it's a different kind of video. So this one's going to be a little bit about options, specifically selling call options or covered calls, okay? This is to kind of fulfill that request that you guys have been giving me here and there in the Discord for some options content, and a little bit maybe to introduce you guys if you guys haven't, heard of this. So just to be very clear, you don't need this to be successful. This is just an additional tool that becomes available to you after a certain stage. And maybe this inspires you to get to that stage as well. So that stage is anytime you have exactly over 100 or 100 or more shares of a company. So you need at least 100 because it's 100 per contract in order to sell a covered call. There is the poor man's covered call, but we're not going to talk about that because I don't even think that's responsible. But regardless, look what that is if you're so curious. But you don't need it. All right. You don't need that. All right. So covered calls is something I'll do on occasion in order to generate some extra yield. And so I'll walk you guys through my thought process. I'll show you guys some of the ones that I have done in the past, particularly with Aerojet Rocketdyne. So you guys have been seeing, or if you guys have been paying attention or coming to the live streams, you guys have heard my commentary here and there. So this is some of the ones I've done. I've done it at twice. I found it that I did it twice this year, and I'm pretty sure I only did it twice. I don't remember doing it a third time, but I for sure did it twice. Okay, so here's the one I did more recently. This one is for July 28th, 2022. The reason why this video is inspired to be done today, hopefully it comes out by Friday, is because they expire tomorrow, or they expire on the August 19th. And this is being filmed on August 18th. So if you guys are watching this afterwards, you guys probably know whether or not it was successful. So I sold some contracts here. We'll talk about the thought process behind this. And then I also sold the exact same trade basically back in 4/11/2022, and that was for expiring on the previous month or the next month. This one was actually a 1-month contract. This one's technically less than that, and it's for the exact same 52 contracts for Aerojet Rocketdyne. So with that being said, let's go over to some of the thought process. So we kind of go to the portfolio. I do see that some of you are actually in here watching with me, but Aerojet Rocketdyne is up about 15-ish%. You can kind of see it right there. So it's up 14.55% so far. Tomorrow, if it closes under that 45, I'm going to keep the shares. I won't have to sell it. But if tomorrow it closes at 45 or above, I'm gonna be called on those shares, and I'm gonna lose the 52 contracts worth of shares. Okay, so that being said, if we take a look at it from this perspective, right? What am I thinking here? Well, it's a stock that I'm not married to. I'm not overly excited in terms of keeping it. I do think that there is a thesis where I do really well, but I'm actually happy to let it go at the current return, because I've only owned it for about almost a year now at this point. So I'm actually really hoping I don't get called, because I don't want to incur that short-term tax liability. And I'd rather get that long-term tax liability or tax treatment on these shares. So that being said, so that's, I guess you could say, the risk. The risk is I lose out on some of this gain because I'm going to have to pay more taxes on it. So if I go through my thought process, I already kind of wrote out the number. So we're using just a strike price of 45, the average contract or premium per share at 65 cents. That gives me an absolute yield of 1.44%. Now, what is this 34%? This is the annual. All right, so the annual yield is 34.67%, because if we remember, it's about for half a month. So then the full year times 24 gives us 34.67%. I only think about that in terms of whether or not it's worth it. I don't care about that when I'm measuring total performance or total return, because now when we look at the total return, if I sell it, it's going to be about 15% tomorrow. So I'm still at a win-win, and then I'm going to eke out with my contracts that I've been selling about an additional an additional 3%. So it comes out to a total of around 18% return in less than a year. That's pretty good. Okay, so that's within my realm of acceptance. Okay, definitely within the realm of acceptance. So and best case scenario is tomorrow it stays under. You guys who are watching this at the time, maybe after the Friday, you guys are watching this, whether or not you guys already know if it was successful or if I'm happy or not happy. Well, I'm happy either way, but like more happy, because then on Monday, I'm going to probably try to sell some more contracts, generate an extra yield. And I'm probably going to, if I want to sell it at a strike price, if everything kind of stays where it's at right now, if I sell a strike price out for a month out now at 45, then I'm going to get even better yield. And that changes the game even more. Or maybe I decide to extend it. I'm probably more likely going to increase what the strike price is so that I'm more likely to keep it and participate. I'm not going to be too surprised if Elliott Asset Management does end up deciding to take it private, by the way, because Elliott Asset Management has been taking a position in Aerojet Rocketdyne. It's not a guarantee that they're going to do that, but I would not be surprised if they decide to do that because they are of the market cap, and some of you guys have been talking about this in the Discord. They are at the market cap range that it would kind of make sense for Elliott Asset Management. Some of the reasons why they might do that, I've discussed this in videos dedicated to Aerojet Rocketdyne. It's actually one of the reasons why they're in the portfolio is because they have a real estate property portfolio within their holdings that doesn't really make sense to the core underlying business, but they have it, and the potential net realizable value probably could equate somewhere close to the market cap, maybe half of the market cap. The point is it's not really known. I'd probably put that to the side, and that's like a call option, so I'm not really investing for that, but it's again one of the reasons why I acknowledge it and I understand it's there, so I understand it's part of the value proposition. Okay, so another company that I have been selling call options on is Unum, and I've shared that one as well, so I'll share that again with you guys here. So I haven't sold it on the full position. So with Unum, I'm being pretty selective. So in hindsight, I should have waited here. So this is an example of when things can go a bit south. Now, it's not fully south. So what you're basically getting here with Unum is I sold it at a strike price of $35. If you look at Unum's today, Unum's price is about $39. So when I talked about this with Unum, I talked about how it wasn't the full position. And so I'm still in a win-win scenario with these the ones that are under contract, or the shares that are under contract, and their strike, or sorry, the expiration is in December, I believe. Yeah, it says right there, December 16th, 2022, strike price of 35. So if that date passes and we are at 35 or above, I'm going to lose those shares. I'm going to sell them for 35. I have an opportunity loss. So there's an opportunity cost that had I not done that, had I not sold these contracts, I would have been able to sell them at whatever price they are at that date. Or you could also think about the opportunity cost that I could have gotten a better premium had I done this today. I could have probably gotten I could have gotten an insane yield in comparison to what I ended up getting, which I still got a decent yield. And maybe I could have actually even extended what the strike price was, maybe make it into the $40. So that was a possibility that I could do. And I might end up doing this for the remainder of the shares, maybe tomorrow, Monday. Maybe I don't decide to do that and I decide just to hold it off. But either way, while I'm holding those shares, I'm still going to be receiving the dividends. So that's all well and good. And the yield on cost is really fat on those Unum shares. So yeah, that's again what I've been thinking about with Unum. So with call options, more often than not am doing the selling of call options. I'm not typically buying them. However, I don't not do that, right? I do that on occasion. And what call options allow you to do is they basically let you take on a bit of leverage. Okay, so what I mean by that is you're basically putting down a smaller amount of capital down now, and in order to control a larger pool of capital. So let's use the person here as an example who did this to me. So let's take, for example, one contract in this example. So regardless of regardless of anything, it represents 100 shares. And so the 100 shares is always, with every single contract, whether it's a put, whether it's a call, it always represents 100 shares. So the person who purchased the contracts from me, okay, right now they're not too happy because right now they're sweating bullets. If it's a retail investor, if it's an institution, they're fine. They're just doing that to hedge their bets. But if it's a retail investor, they're sweating their bullets. And if they were holding it for trading purposes, they're definitely sweating bullets now because we have about 1 day till expiration and we are below the strike price. Okay, so if we're looking at it from here, we know that the total capital controlled, we can just do this. This is about the capital that you are controlling. So you're controlling $4,500, and this is the control that you have. So this is what you control. Now, if we think about from the cost, right, this is the premium, total premium for one contract is equal to the 65 cents, right, that we have here, and we just multiply it by there. So this person is putting down $65, right? So $65 down, you are controlling $4,500, okay? So if you have a lot of investments, you don't have much cash, but you do want to participate in the upside of an equity, you can do this. Now, there are some caveats here, and I'm going to keep it pretty basic, but the caveats are what a risk that you have with options is time, right? You don't have that time necessarily, or that risk with common stock. With common stock, there's no one hampering down your door saying, hey, the time's up, you can't own the stock anymore. Well, with contracts have an expiration, right? There's a time stipulation, okay? And that time stipulation, once it's over, the value is gone, right? Unless you are above what you agreed for. So let's say if it's above $45, the value of that contract is there because I can use that contract. So it has tangible value. I can use that contract and I can buy the shares for 45, and then let's say it's trading at $50 a share. So if the contract is trading at if the shares are trading at $50 a share at time of expiration, then you still have tangible value there because you can use the contract to purchase shares at $45 and in theory sell it at $50, right? So there is value there actually to be had. Okay. Now, the closer you get to the expiration and the less, let's say likely that it's going to get into that range, you're going to see the value of that bond, or not that bond, that option decay rapidly. So again, you got to be very careful whether you're on the put side or the call side, and you're the buyer, you got to be careful with that. And then if you're on the seller side, well, you have a bit more, let's say, control over your decisions, right? You shouldn't be entering into an arrangement that you otherwise wouldn't want to partake in, okay? And also, one more question that you might have is another part as to why I don't do them for everything is because, one, I don't want to get rid of some of my shares by accident. I don't want to get called on them. So I don't, even though Alphabet is a lot more versatile now that they did the split, and I talked about that when they did that, so I can kind of customize the cells of contracts a little bit better now. I wouldn't really want to do that in the offset chance that I do get called on them and it ends up being a mistake and I incur a huge tax liability. I don't want to do that. So I don't do it on that. And depending on the stock that we're talking about, the market for their options are going to be different. So some of them are just not very good. It's just not very appealing. So I do kind of a mental math of an annualized rate of return. It's not the best way. You might have an even better way of doing it, but it's the way I do it for myself. And so I'll analyze each individual company, each individual opportunity on its face by itself in isolation and make my judgment from there. Okay. So that's basically a little bit of a glimpse. And if you guys have any questions from this, you can kind of catch me on the live streams and I'll be more than happy to answer your question. If you comment down below with a question, I can try to get back to you in a reasonable time period. I don't have as much time as I used to. Like I told you guys, I had that hiatus or that transition point where I had a bit more time. You probably noticed more content than normal. And then now we're kind of I'm trying to figure out my schedule to try to still post videos here for you guys here and there, but just can't do it at the same frequency as I once used to. All right. So with that being said, guys, thank you guys so much for watching, and I will see you guys on the next one. Bye.